Welcome to Multifamily Rockstars. If you are new to apartment investing or already experienced, you will enjoy this show. You will hear from the leading experts in multifamily real estate so that you can be a better owner, operator, and investor. Real people, real stories, life-changing. And now, your host, Ryan Christopher Nunes.
Well, welcome to the show. Today's guest is Shameer Soni. Shameer is a partner at Patel Law Group in Dallas, Texas, and is a member of the State Bar of Texas. He has represented clients in over 100 multifamily transactions in the purchase, sale, and capital raising of real estate. Shameer is a super lawyer's rising star from 2015 to 2019. Shameer, welcome to the show.
Thanks, Ryan. Appreciate you having me on.
Let's get right to it. Walk us through your background, Shameer. Tell the listeners a little bit about yourself.
Yeah, definitely. So let's see. So I started practicing in 2008. So we're 12 years in, which has flown by. I went to law school at Baylor. I did an LLM at Emory Law School over in Atlanta, and I joined a large firm in Atlanta back in 2008. There I practiced primarily film finance, so I had already gotten a good gauge of what debt looks like, what waterfalls look like, how the security side of a film deal works, which is significantly more complicated than multi. I then moved back into Dallas in about 2011 and started kind of a basic real estate practice. That developed, and about 2-3 years ago, we really started focusing on multi. In 2019, we did about $1 billion in deals, and a lot of that was PSA, some of it was securities, and then in 2020, we really made securities a focus of our practice too. So, my practice right now is almost exclusively multifamily real estate. I have a colleague, Sean, who I work with on the security side, and his practice is exclusively securities, and then the rest of my team works with me on the transactional side and security side. So our team, our transactional team at the firm, consists of 5 attorneys here in Dallas, and then we have an office in Oklahoma City and an office in Houston, and both of those are transactional. So we have 7 attorneys on the deal side. My primary associate is Jonathan Jascott, who a lot of our clients are very familiar with. He worked on a ton of deals, and he was actually on the lender side prior to joining our firm and did loan docs for the big lenders for 4 years before joining our firm on the borrower side. So, we have a really robust team. We've kind of compartmentalized the various functions: securities with Sean, transactionally with Jonathan, and then I essentially run the entire deal from a partner perspective, and I'm really more hands-on as things become a little more complex. Typically, if it's an easy deal, I won't get too involved outside of the PSA phase. So that's kind of our firm. I have 2 young children, 4 and 7 months, and live in Irving. So I'm very fortunate. Our firm's been growing very, very quickly. Obviously, we're a function of the multifamily market, which in Dallas and the state of Texas has been on fire. So, we're fortunate to be right place, right time, and we strive to provide great value for our clients and our folks.
Great. No, appreciate that background. So what services do you offer, and how is that different from other law firms?
Yeah, so obviously we're a law firm. We also have a title company. We're a Fidelity National Title fee office. We're the second largest Fidelity National Title office in North Texas. We closed just through our Fidelity office about slightly under $1 billion, about $975 last year. And we expect to exceed $1 billion a year as long as the coronavirus doesn't last too long. I think what we do differently and what we take a lot of pride in is we're very, very hands-on in terms of strategy on deals. There are a lot of attorneys that will be happy to draft docs and to draft PPMs, but they don't really get into the nitty-gritty of decision making. and advising clients on opinions and industry trends and, the business decision side. And I think what we do and what allows our firm to really add value to deals is we're able to say, you want to do this, but this person did this other person did that, and this third person did something different. You fall somewhere on this continuum, and we think that you're a little too far this way, or a little too far that way. We would recommend you move to a certain decision. And what that allows our clients to do is obviously be more confident in their various positions. It's been exceptionally important right now in this kind of coronavirus environment, and we've had to be more creative with deal structuring. What do we do on PSAs? What do we do on deals we already have under contract, deals that are about to close? How do we mitigate some of the risk that exists now that didn't exist before? So I think what we generally what we add is kind of show that title companies is fantastic, and I think we have some of the best people in the city, probably in the state, on the multifamily title company side. But I think the big thing we add is just a ton of deal knowledge, deal expertise, and the desire to treat our clients' deals like they're our own personal investments.
That's great. So you obviously mentioned COVID-19. That's on the forefront of everyone's mind. So just walk us through, some of the hot button issues right now that you're seeing from the legal side.
Yeah, no, I think obviously, the COVID-19 situation has really caused a lot of problems for our folks. When the virus hit, we were probably at 20, 25 deals either under contract or pretty heavily in negotiations. That quickly widowed down to about 2 or 3, and deals trickling in now, but they're 1031 down leg buyers or cash buyers. They're really the transaction structure has completely changed, and we saw a really, really quick kind of whiplash from the extremely pro-seller market to what quickly became an extremely pro-buyer market. And I think all our clients were struggling to adjust to how do you do that? What do you do? So some of the things we did on the COVID-19 side in terms of deal terms, so we went back to tossing in a financing contingency. And that was a function of a couple of different things. Fannie Mae obviously tightened their belt on what they were going to do, which forced our clients into a little bit of uncertainty on what underwriting looks like on the debt side, and the knock-on effect is what a deal looks like on the return side. So we ended up, we started putting in financing contingencies with kind of terms that we think work, or at least are reasonable from an underwriting perspective. And then if we can't hit those, then that doesn't make sense. We've tried to push out deals as far as we can. I think generally our opinion on the COVID-19 situation is that it's more of a shock a la 9/11 and less of a systematic kind of meltdown of the debt markets or the capital markets like 2008. And if it is, more of a shock, 2001 style, then we expect that as things clear up and people are able to get back to work and back to inspecting properties, and the lenders are back to being fully functional, cities and states are to being fully functional, the return to normalcy on the multifamily investment side should be pretty quick. The biggest headwind right now is going to be that a lot of our equity on our syndicated deals just lost 40% in the market. And so, the second piece of the recovery on the multi side is going to be a macroeconomic recovery that will allow our investors or our limited partner equity to step back into. There's two components to a transaction. You underwrite the deal, but then you still got to raise equity if it's not your own money. And without equity, whether deals look great or not, that reduces the pool of potential buyers. Sure. So I think that's critical. So again, one of the other, that was extension options. We've started including a force majeure provision in our contracts. It was something that wasn't really thought of much before. And the way you do that is typically through some sort of material adverse change, we call a MAC clause. And so we started to include some of that and really kind of expand the definition of that material adverse change. We've talked to some clients about kind of price adjustments, and this has been a really difficult one. But where price becomes a function of collections, one of the things right now, it's April 3rd, which means we haven't collected the full month of April yet. We haven't got to the 5th. So, we don't truly know what the knock-on effect of people being out of work is on rents until the 5th of April and then the 5th of May. So with that, we're trying to factor in some sort of collection-related contingency or occupancy-related contingency, economic occupancy-related contingency, some sort of number to tie back the trailing, the T3, T1 to the price and make sure that they remain correlated, and that ties into the underlying debt. If our debt's a function of our T1, T3, and we've got a shock which materially affects the T1, T3, then that's going to make a major dent in your debt. So that was the other thing that we've started to really look at closely in connection with deals as a function of COVID-19.
Okay. And then if we shift to the CARES Act, what are your thoughts on that, and what, whether owner operators, how they can benefit?
Yeah. So there's really two separate pieces on the economic recovery side. We have the CARES Act, which creates what we call the Payroll Protection Plan, PPP. And then we have the SBA's 7A Economic Disaster Loan, or EIDL program, Economic Injury Disaster Loan. Two separate programs. PPP, the Payroll Protection Program, is difficult for us to really make a lot of sense of on the multifamily side. Multifamily properties are typically very salary light, because the salary is going to be carried by your management company. So, there isn't, it's 2.5x your IRS 1090, IRS 920, but there really isn't a true 920 coming out of the property ownership entity. So you don't really have the ability to do that.
Okay.
There's been some conversation among some of our hotel clients, which have a similar structure to multi, where they're third-party managed, about whether you can pass through the management company's salary to the owner's application for PPP and say, hey, this management company has 5 employees that are dedicated to my property. Therefore, all 5 of those salaries I should get 2.5x, 1 month average salary of those 5 salaries. Treasury issued guidance yesterday. Didn't really issue much guidance on that. However, they have promised to issue additional guidance on some of those items, and that may be on the table. On the multi-deal, our typical payroll is $200,000. You're gonna take 1/12 of that, which is about 18 grand or 17 grand. Multiply that by 2.5. So that gives you about $40,000, $40,000 in spending money to help tide you over through this shock. So that could potentially be out there. Right now we're kind of telling our folks to apply for the PPP, and then we'll solve the salary problem on the back end as we go through underwriting. But if you don't apply, you're not going to be able to get that money earmarked for you. So there's no way you can.
And Shameer, could the property management company apply on your behalf, show that, okay, this bank account number is for this property, and if they get the benefit, then pass that back through to the.
So we've thought about that. I don't know. A lot of our property management companies, you look at some of the big names, they manage 50, 60 properties. I don't know if they want to take on the liability of applying and trying to parse out proceeds. Also, the use side, the proceeds must be used in a pretty short window.
Okay.
I think it's like 90 days or 80 days post need. And so, the way it's originally structured for a more conventional business is you're going to use a big chunk of it for salary, and then you're going to use some of it for your rent and your OPEX. It doesn't make sense if the money's going to the management company the transfer of that back to the property company, and then the expense, the use of that and the reporting back. I don't know if it makes a ton of sense. I think you almost have to have it paid into the reporting company to really make sense, the property company to make sense. The other program, I talked about PPP. The other program is the Economic Injury Disaster Loan. Up to $10 million is available there per borrower. It's a 3.75% loan, amortized over 35 years, repaid. It's paid on a 10-year term. It's a 7A program. It also includes a $10,000 advance paid within 3 days of application. That's forgiven. So that 10K is kind of like a company's equivalent of the $1,200 that an individual is going to get.
And that doesn't hurt your credit or anything like that.
No, so that doesn't trigger that. It's an unsecured loan. The challenge is how that interfaces with some of the no other debt language in Fannie's loan docs, some of the bridge loan docs that exist that are even tighter. How that interfaces there, and we haven't really had much guidance. I've reached out to some lenders councils to kind of discuss that, considering it's unsecured, but we haven't really got a straight answer back yet. But the EIDL loans may be where a lot of our multi-borrowers end up kind of reaching to tide themselves over through the dip in collections. The other piece that's really in play right now is what we call the Fannie Mae Forbearance program.
Okay.
So Fannie Mae going through, if you have a Fannie Mae loan, and this doesn't apply to your bridge product, but if you have a Fannie Mae loan, they're agreeing to forbear 3 months worth of payments, kind of as a matter of course. Those 3 months are going to be then split over the following 12 months. So you're going to make bigger payments for the subsequent 12 months. Since you didn't make payments for 3 months. The real issue there, though, is on new originations, Fannie's requiring 12 months of P&I escrow.
Mm-hmm.
And that's a pretty decent chunk of change. And that's definitely kind of being materially affecting the underwriting on our clients' deals.
Absolutely.
That's obviously going to pressure the return. And the last term sheet I saw, that P&I escrow doesn't get released until one of two consecutive quarters of 1.3 DSCR or the month 36. And this was on an Arbor term sheet.
Yeah.
So 1.3 DSCR, that's tough. You got to get a pretty good price to be able to get a 1.3 DSCR. So you're almost going to be tied in for 3 years on that escrow.
Mm-hmm.
So that's kind of what we're seeing right now. In terms of deals getting done, like I said, deals are still getting done. There's some deals that are getting done on balance sheet product,
okay.
Where your traditional bank lender still has liquidity. There's some deals that are getting done on a Fannie Mae product, but you've got that 12-month P&I piece that if you're forced into it, you're going to take it, but you really don't want to because it means you got to raise more money. The bridge programs right now we've seen have been very, very slow. I think for example, Arbor has a bridge program. They're still trying to figure out what they're going to do with their existing borrowers before they start to take on new borrowers. So we have a handful of clients that are Arbor Bridge, and they're calling me, and essentially they're like, what do we do here? Do we get into capital calls? Do we get into more money from our equity because our debt isn't really willing to have a conversation about restructuring this stuff? So that's obviously problematic, and we're kind of working through some of those things. Ideally, we're on a stay at home until May 20th. If after May 20th the market starts to open up, we could see some normalcy by late June, early July.
Okay.
And I'd expect the Fannie 12-month deal to kind of disappear once the market stabilizes again. I think it's just a function of the
some cushion
uncertainty. Yeah, the uncertainty in the market right now, and the fact that Fannie's already on the hook for these forbearance programs that they're being jammed into.
Okay, no, appreciate it. And then is there any legal advice or guidance that you're providing to your owner operators in terms of dealing with tenants during this time frame?
Yeah, so
To,
tenant, there's a couple of different things. With tenants, obviously we have the limitation on our landlord's ability to evict. That does not, and that the limitations there's a couple of carve outs to that, right? There's one of them is domestic violence. The other one is risk of harm. So there are some carve outs. There's still ability to evict if your guys are really bad. Uh, but monetary reasons alone are not adequate right now to evict. That doesn't prevent your tenant from being in default. I mean, the rent's still due, whether you have the remedy of eviction or not. The underlying rent is still due from that tenant to the owner, and so you know, from a landlord perspective, you still tell your tenants your money's owed, or you can still tell your tenants. Um, what we're recommending to our clients is, look, you know, workforce wise, we may make it through April, but we're probably not going to make it through May. And even June's going to be tough because the people are probably just getting back to work.
Mhm.
Ideally, some of the incentive stimulus money will have hit by then, and people will have cash. But I think the real crunch is going to be May.
Sure.
There's a couple of alternatives. There are some county-based assistance programs. Dallas County has one that are for low-income tenants. There are some faith-based programs that exist for folks that can't make their rent. The other thing we've actually seen, which I think is really interesting, is our owners are hosting or are providing alternative employment sources. So, if my employees were, um, primarily working in food service, and they've been, whether they've been fired or whatever, um, can we point them to Amazon? Can we point them to Domino's, which is hiring, or Pizza Hut, or some of the folks that are looking to fill jobs? Can we point them there and ask our guys, if you really want to work, there's a couple of opportunities here that may still be available. And so, kind of being proactive on that side and trying to solve the problem instead of harming people for not being able to make it. So we've seen clients do that. We've seen clients kind of double down on some of the community efforts that they can. So whether it's helping tenants with testing and telling them where to go and how to get tested, and how to maintain a sanitary unit and make sure that they're able to disinfect regularly and stuff. Making toilet paper available, making wipes available, making
Sure.
bleach or whatever, cleaning supplies available. I mean, just those basic things. Trying to drive tenant loyalty just through doing good deeds.
Mhm.
And I think that will carry value too with tenants, and kind of help drive their desire to make payment if they're able to.
Oh, that's great. Thanks, Shameer. I appreciate that. So, walk us through at a high level, moving on from COVID, walk us through at a high level the legal documents required in a transaction, and then let's dig deeper into each one of those.
Yeah, definitely. So kind of going back to our regular job, assuming there's no virus. So talking through a transaction, your transaction would typically kick off with some sort of LOI, letter of intent. You've heard the terms best and final, where a seller will evaluate one, two, or a few letters of intent, evaluate the buyers, kind of underwrite the buyers and their likelihood to close, their ability to close. And if we have a finally executed letter of intent, that's kind of your initial kickoff document, where even though it may be non-binding, it's where buyer and seller say, okay, here are the core economic terms of this transaction. The letter of intent is then typically passed on to the attorneys, who prepare a purchase sale agreement, purchase contract, contract of sale. It goes by a whole host of different names, but the agreement the binding agreement between buyer and seller to transact on the property. Once we have an executed PSA, which would trigger the due diligence period for the buyer, if it's a syndicated deal, we will, or Sean will at our office, engage with the buyer on, where they stand with respect to offering, what their planned structure is, how much money they intend to raise, what rights their investors are gonna have. And the way we run that at our firm is we have a pretty robust questionnaire that we start with to really get a good gauge of where our syndicators would like to go with the transaction.
Okay.
And then based off of that questionnaire, we'll then drive the remainder of that conversation with Sean. And we typically do 506B structures, which we'll get into afterwards. And so we'll do subscription agreement, private placement memorandum, operating agreement in connection with the fundraise. Typically, once your fundraise is complete, you're going to be probably a week or two out before closing, ideally when you have your money in. We'll engage with lenders counsel, make sure the loan docs are complete. Fannie, if you're using Fannie Freddie, those loan docs are what we call promulgated. I mean, there's a structure that Fannie has, and everybody uses the same structure. You have to use their forms.
Okay.
But then if you get into like a bridge product, for example, the loan docs are more bespoke and require more time and more granular reading to ensure that they're consistent with kind of our client's best interests, whether it's dealing with carve-outs or non-recourse provisions, or renewal provisions, or the covenants in connection with the loan, how DSCR is calculated when it's reviewed, some of those things. So we'll review loan docs pretty closely on bridge product, and then we'll engage with the other side, typically sellers counsel, to complete the close docs, and your typical close docs on a multi-deal. This is the deed, the sale, assignment and assumption agreement, and ideally a certified rent roll. That gets us kind of through transacting the property. The post-transaction item is the SEC Form D, which has to be filed within 15 days of raising money, and the associated what we call state blue sky filings, which are typically on a similar timeline, and must be filed within at the state of residence for each investor. So individuals where they reside or primarily reside. For entities, it's the state of formation. So we'll handle that typically as a post-close item, since our financings will close right at or immediately prior to the transaction close. And that's kind of the continuum of transact talks.
Awesome. No, that's great. So let's dive into each one of those. On the PSA, just walk us through some of the things that either the buyer or seller should focus on.
Yeah. So I really, the PSA it kind of is what you make it. We work with a host of different brokers, owners, buyer, seller counsel on the other side, and everybody has their own way of doing things. My position on the PSA is it's a couple of different things. You build on the LOI with respect to the economic terms. Mm-hmm. So at that point now you have a much more robust set of detail surrounding the economic terms. And then the other big thing is you state the representations and warranties in connection with the transaction. As the buyer, you want seller to say, hey, my rent roll is accurate. Hey, the contracts that provided you are the only contracts and they're accurate. Sure. That my buildings aren't burned down, that my tenants are all in place. All those sorts of core representations that a buyer would want from a seller, you want those stated very clearly in that purchase and sale, purchase contract, PSA, whatever we call it. In terms of key terms that we look for as a buyer, you typically want some sort of make-ready credit or rent-ready credit. One of the things we've seen, as I said, in this COVID-19 market, is this occupancy contingency, which is kind of like a super rent-ready credit. What we'll do is we say, okay, look, if you have 100 units, the first 5 we'll give you. 5 to 10, you give us X in rent-ready credit or make-ready credit. And then if there's, more than 15, then we have an option to term, or something to that effect. Okay. So, that's something we've started to see more of, and we've started to include more of. just to ensure that a property doesn't, take a bad twist while it's under contract. And that's we've had anecdotally stories of that sort of thing happening where a management company got wind of that their property was going to be sold, the property they were managing was going to be sold, and the management quality dropped off. They weren't turning units, they weren't getting units ready. Well, at that point, occupancy drops, rent drops, and that slope downwards is very, very quick. So that's something we've started to try to insulate from with reps and warranties and what we call post-execution pre-close requirements.
Okay.
So yeah, no, that's, and then one of the big things is, as a seller, you want the as-is language. That buyer gets the property as it is, and they get what they get. As a buyer, you want the seller to make as many representations as possible to cover your mishaps in the review process. So kind of goes both ways, but you have there's a competing set of interests between the buyer and seller in a purchase contract. The economics have been established.
And then, Shameer, is there anything in terms of non-disclosures that can be inserted that would be helpful in terms of property tax protection?
Yes. So you can include a confidentiality provision that applies to a buyer, seller, title co. I've heard kind of anecdotally from other people. You also want to include the brokers on that confidentiality provision.
Okay.
Some of the rankings you see in the magazines, and it's like X person did Y $1 billion in sales this year or whatever.
Sure.
Those are supported by people sharing parts of a purchase contract. So ABC ranking service may say, if you want to be ranked, you need to give us the top page of each contract. Obviously, we as a law firm have attorney-client privilege that prevents us from ever doing that. But there are other businesses engaged in the transaction that may not have that same degree of confidentiality.
Sure.
So you do want to make sure that you account for that in the purchase contract.
Okay. And then anything else on the PSA before we shift to the PPM?
The big thing with PSAs is if you don't get an executed PSA, you're not going to get a deal. So, what we tell our clients is we ask for everything. We won't get everything, but ask yourself whether what you're not getting is critical enough for you to want to continue to fight over. There are some terms that you're willing to take risk on, and some terms you're not. Understand how much risk you're taking, and make a calculated decision on whether you want to take that risk or not. The answer is never I want everything, because you're just not going to get it. So generally, as attorneys, our objective is to measure risk and make sure our clients understand that risk, and then determine whether our clients want to take that risk or not. And so you can do that on a almost clause by clause basis in the PSA. And that's how I urge our clients to think about it when we get red lines back.
No, that's great. That's really helpful. So yeah, let's shift over to the private placement memorandum, the PPM.
Yeah. So PPM, we hear, so in a syndicated deal, you really have three docs. You have a PPM, operating agreement, subscription agreement. The PPM is a memorandum drafted by the issuer, by the buyer, to its various investors. And the objective in the PPM is to make sure that everybody's on the same page with respect to the economics and the risks of a transaction. There's really two phases to a PPM. You have kind of the front half, which is here's our deal, here's why it's great, here's our team, here's why you should invest. And then the second half of it, which is here are all the risks and all the reasons why you should not invest.
Sure.
The objective with the memorandum is to make sure that all the cards are on the table, both in terms of transaction and in terms of risk, so that your investors don't have the opportunity to come back to you and say, oh, you didn't tell me that you were taking this fee. You didn't tell me that you are selling yourself the deal, and it was an internal deal or whatever. I mean, there's a whole host of different things clients can come back to. You didn't, you didn't tell me that we're going to have to spend X million dollars to remodel this whole area, and therefore there's more risk. I mean, all of those things you want to try and address in your offering memorandum. Um, Clients often prepare a deck, and the deck's a really great first half of that offering memorandum, but the second half still needs to be there from a risk perspective.
And is there any, I guess for people that are in the stock market, is there any parallels that you draw to multifamily documents to, equity documents, whether that's a 10K or so forth?
Yeah, when you look at mutual funds, there's a prospectus, right? And that's fundamentally a super PPM. And so that's kind of the public, the big SE, the non-private placement side. The equivalent is the prospectus. That's a registered security, hence they have a prospectus. A private placement is obviously an unregistered security, hence you have the memorandum rather than a full-on prospectus.
Yeah, perfect. And then in terms of, you had touched upon 506B and you mentioned we'll dig deeper into that. So maybe, talk with us about 506B offerings versus 506C and the risks and rewards associated with each.
Yeah. So this is always kind of a hot topic. 506B versus 506C. What's our opinion? We typically have our clients tend towards 506B offerings. And the reason is, it's as much a function of our clients as it is a function of us as a law firm. Our clients, at least until COVID-19, had a pretty good grasp of their equity pool prior to even putting a deal under contract, to be honest. And 506B requires a substantial pre-existing relationship with your investors, and so and there's no general solicitation, there's no marketing, there's no ads, there's no nothing. I mean, you better know these guys that are putting money in before you did the deal, and you better know them outside of the concept of just you do deals, and then when they invest, you're protected by the 35 unaccredited, unlimited number of accredited investor provisions of 506B. 506C allows you to generally solicit. You can do ads. You can do Facebook ads if you choose to. But the flip side of that is all of your investors must be accredited. And there's a verification process which potentially could take time and create what we in the tech business call sign-up friction. It's
a good term.
It's harder to get. There is a challenge of there's a bridge you have to cross from interest to investment, and that bridge is significantly more difficult in a 506C where you've got to verify versus a 506B where you already had that pre-existing relationship, therefore already did your verification, and now all you're doing is asking them to take a couple of steps. So that's why we've tended towards a 506B. And our clients have too. I mean, we've had clients start on a C and say, hey, look, nah, we don't want to do this whole verification thing. We don't want to have to deal with investors, CPAs, to try and explain to them why, we have to, why we need a verification letter, or we have to explain to our investors why they need to submit their tax returns to a third party to verify. That's a tough ask of a lot of investors, especially when you're an existing syndicator and those investors may have participated in prior deals. And even though those prior deals are 506Bs. So our experience has been 506B has just been a little bit more smooth. I'm not personally adverse to Cs. I just think it's got to be the right kind of client to do it. And the fact is, if we go into a slightly slower market, we may see more 506Cs than we did CBs, because the number of unaccredited is going to go down, and you're going to have to fish further to get your investors. So and your timelines are going to be longer when you're in a slightly slower market than a pure seller market that we were in pre-COVID-19.
Sure.
We may see that.
And then Shameer, in terms of, advertising, what do you, and I guess just generally social media usage, what's the advice that you give to clients around their Facebook accounts and Instagram? And all
So my big thing So my advice on social media is generally, if we're doing a 5, so if we're not in the midst of an offering, do whatever you want. But don't make promises on returns and some of those, real basic things. If we're in the midst of an offering and it's a 506B, don't talk about your offering. You're supposed to be working with guys with whom you had a substantial pre-existing relationship prior to the transaction. So the value of social media at that point is limited, given that if somebody solicits you based on a social media ad, you didn't have that substantial pre-existing relationship prior to the deal anyway. For 506Cs, I think it's a great option. I'd recommend it for Cs. I think you got to be as creative as you can on the C side when it comes to fundraising, and social media is one of those platforms, and I know there are folks in our market who use it.
Thank you. And then if we go to the subscription agreement, going one by one, just walk us through what that is and the important things that investors
so
focus on.
The sub doc, and really it's a subscription document and an investor questionnaire. What we do is we use the sub agreement and the investor questionnaire to, number one, have the investors sign up for whatever number of units they're acquiring, promise to pay, represent that they're not illegal banks, laundering money, some of the bad things you don't want your investors doing. So we make sure we do that. But then we also ensure from a 506B, 506C perspective that they're either accredited, or if they're not accredited, that they're adequately sophisticated to invest in a transaction in 506B. So there's kind of, again, 3 phases, right? It's number 1, subscription, number 2, accredited investor questionnaire, and then number 3, if they're not accredited, sophisticated investor qualification.
And then are there any things that you suggest that clients include in that?
Yeah, I don't think it's as much about including. I think the big thing with sub-agreements is you've got to build them in a manner that's kind of logical. Most of the subscription platforms, whether you use DocuSign, IMS, whatever it is, there's no if and logic, right? It just takes up 4 minutes. Says you can check wherever you want to check and sign wherever you want to sign. Well, if we have to build our forms in a manner that kind of have that natural logic to where if somebody's accredited, they don't go waste their time filling a certificate of question. So, my suggestion is always make sure that it reads and fits and it fits together as kind of a logical flow rather than, it just creates more confusion with respect to what questions need to be answered and what questions don't.
Perfect. And so on the operating agreement, just walk us through what you advise clients to include in that.
Yeah, so the operating agreement, and there's really 2 operating agreements in most transactions. You have the borrower or the syndication entity operating agreement, and then you have an operating agreement between the manager entity. That's the entity that is the Class B member of the property entity and is your sponsors, your deal principal. That's the entity that collects the AM fee. That's the deal that collects the carry. That's the entity that collects the carry. So at the borrower entity level, you always want to have a really robust understanding of the waterfall. What are the triggers? What happens in a refi versus what happens in a sale? What happens if one of your sponsors die? What are the transaction? How do we do a right of first refusal when an investor wants to transfer his interest or her interest? What happens to the spread? Are we able to charge a fee? There's all these kind of economic questions, and that's what the operating agreement is. It's really kind of the meat that sits over the entire deal. It's what everything has to be judged by. So you want to include as much detail as you can in there to make sure that you've already established kind of an objective set of criteria that your deal can be measured against. The big thing for me is on the management side, you want to make sure you have a really robust dispute resolution mechanism, whether it's some form of shotgun or buy-sell structure, whether it's some form of parsing out decisions between the various members. How do we deal with when we have multiple sponsors? How do we deal with guys that are not on the same page, sponsors that are not on the same page. So that's what that manager OA is there for. Uh, the other big thing is you can have an asymmetric distribution of asset management fee, carry, um, guarantee fee. If you have those and they all flow up to that manager entity, we can do special allocations of those as long as that manager entity is taxed as a partnership, which can be tax advantageous to the sponsors.
Great, awesome, Shameer. I appreciate that. So as we kind of turn to closing out here, any examples from transactions that you've worked on that you were able to bridge a buyer-seller gap for your clients?
Yeah. So like Mark, I said in the intro, I think we pride ourselves on kind of being able to be creative and problem solve deals. We really, like I said, take a lot of ownership in our transactions. We had a couple within this last that I, thinking about that were challenges. We had a deal, right, smaller deal, which had a fire and a non-assignable insurance policy. So, we had to be creative about how we address proceeds, how we address the reconstruction. The construction wasn't going to be done pre-completion. My guys that were buying had a 1031, so they couldn't wait.
Sure.
So we had to account for a handful of different there's a perfect storm, right? You got fire here, which really screws you on timeline. You got 1031, which really needs you to close early, and we're trying to figure out how to get this all to fit together.
Sure.
So that was a combination of escrows and letter agreements and things to get that deal done. But another deal that was a relatively complex assumption deal, but our client really wanted to get it closed on an expedited timeline and getting that thing done in 45 days. It was a larger deal, and speed is always critical, and our clients wanted to really make sure that that they're able to do this deal and do it quick, because they wanted the seller to know, the investors to know that they are, they're organized, and they're one of the most organized clients we've ever had. And they wanted everybody to make sure they understand that, because they felt like that was a competitive advantage moving forward on transactions if they can close one on a really compressed timeline. And then another transaction we had where we were forced to be pretty creative. We had a client using two separate 1031 exchanges to acquire a property. And to do that, we ended up using what we call a tenancy in common, TIC.
Okay.
So we basically ended up having two TIC owners of the underlying property. Fannie and Freddie both have their own TIC agreements that you have to have in place. Worked with them, solved some issues. TICs are state law instruments. So when you're working with New York Counsel, who's typically the Lenders Council, they don't really understand how TICs work in Texas. So we spent some time kind of educating them on the relevant law, making sure they were comfortable getting that deal over the finish line. And so that one was a good little win. That was late last year. So I think we're able to call on 1031 again is a big thing. I mean, call on experience with 1031, tenancies in common, some of those things to make sure that our clients get the most favorable outcomes on transactions that they're working.
No, that's great. I appreciate that, Shameer. What advice do you have for people getting into the business, both passives and first-time syndicators?
So kind of a couple of different things, right? Number one, and this goes for both, is trust is key. It is the single most important piece of any deal. Whether you're a syndicator seeking to raise money, whether you're a passive seeking to invest money, there's got to be a very, very robust level of trust between the parties. As a syndicator, I'm always worried that I would be worried if I was a syndicator. I would be worried that if my deal goes not as we intend to go, that my LPs either start to litigate or bail out. I've got to trust my LPs that they're there for the ride. They're able to ride through a little bit of a storm, just like clients are doing right now. You've got to trust them to be there with you, and so that's critical. Number two is the sponsors not to overextend. I feel like what was happening, especially kind of in this last cycle, was there was a lot of kind of hit and miss or swing and miss. Syndicators would offer, not make it the best and final, not get a deal. Offer, make it the best and final, not get a deal. Well, every time they do that, they're creeping up a little bit, or they're loosening their underwriting guidelines just a little bit because they want to try and get the next one. You don't want to do that. You've got to stay disciplined and not overextend, because markets shift quickly. And if you weren't disciplined in your underwriting, then you're certainly going to be in a bad spot when the market shifts. And the third thing, which I think is honestly a life saying of mine, is hope for the best and plan for the worst. You always kind of always have a contingency plan, whether you're an investor or a syndicator. I mean, as an investor, putting all your life savings into a single deal, probably not a good idea.
Sure.
As a syndicator, overextending yourself and taking on an exorbitant number of guarantors or an exorbitant amount of guarantee risk, rehab risk, whatever it is, that's tough, because that'll weigh on you, and it'll weigh on your ability to run your transaction. So hope for the best, plan for the worst.
So really appreciate it. How can our listeners get in touch with you?
Best way to get in touch with me. So, our firm, Patel Law Group, patellegal.com, and we'll have our contact info hopefully in one of the little boxes below the video. You can find me on social media, LinkedIn, Facebook. We are, we're part of a lot of the syndication groups, Sunrocks Group, Lifestyles. We participate in all of them, whether as sponsors or vendors. You probably know Josh. I know pretty much everybody knows Josh Samuel, who works with us on our title side. He's a business developer. Josh works with us and is a great resource. If you ever need to get hold of me and Josh, Josh knows where to find me. And if he can't find me, he'll find somebody who does know where I am. And I urge everybody, give us a shot. I think we can really do things very, very well. I think we add value to deals. I think we add really a level of legal competency that's unparalleled. And I think the closing experience with our office is second to none. So, like I said, you can find me LinkedIn, Facebook, just about everywhere. Instagram, I think.
Awesome.
And Josh is always a good way to find me too.
Great. Well, Shameer, thank you so much for your time today. This was wonderful, and really appreciate all the insight that you shared with our listeners.
Awesome. Thanks for having me, Ryan. Thank you so much.
Thank you for listening to Multifamily Rockstars. We hope this episode was helpful for your personal and professional growth. For more episodes and to learn more about investing in multifamily apartments, check out lifechangingcapital.com.